Picture this. You've put away more than 1/10 of your paycheck for your entire career and finally reach retirement. Your super fund was chosen for you, you're in a default option, and now you don't know whether it remains the best option for your retirement or not. There's headlines about different types of super funds and they're endless, as are the marketing budgets of some of the biggest funds. In this video, I'm going to go through the 3 main options you have for your super at retirement and what you need to do when the time comes to pull up stumps and convert that superannuation into a passive income to fund your retirement. Now, in Australia, retirement's typically linked to the age at which you can access your superannuation. In most cases, it's 65 years of age, but you can also access it if you've ceased employment or retired after turning 60 years of age. One of the biggest issues I've seen as a financial advisor is that people spend so much of their lives focusing on their mortgage or savings that they ultimately ignore super until they near retirement, and they have limited understanding as to what their options are or what's best for them. Now, in your saving years, when you're accumulating capital, you can cover blemishes with contributions. You can continue to dollar cost average and buy into the market because you have this forced savings and you're not relying on that money you put in your superannuation account for an income at this point. And that's all well and good, but when you get to retirement, the situation changes completely, and every dollar you have saved to that point is the last remaining dollars you're going to have, and all that money needs to be able to last as long as possible in your retirement. Now, in this video, we're not talking about the investments that are available in superannuation, but more so the types of superannuation funds available to you. Now, there's 3, or sometimes defined as 4, that we're going to cover in this video. That starts with industry super funds, also known as benefit to member or profit to member funds. There are self-managed super funds at the other end of the spectrum. There are corporate superannuation funds, usually linked to your job. And there are platforms, usually run by large corporates and quite popular and used extensively by financial advisors. Now, there's been a bit of a war between self-managed super funds and industry funds for a long time, but in general, every part of this superannuation sector and environment is growing strongly thanks to the superannuation guarantee contributions, and continues to make it the most tax-effective and best entity to hold your retirement assets. So let's start with industry super funds. Now, these were historically profession or union-driven. As we're seeing in the news at the moment, if you worked in the retail sector, if you worked in the construction sector, if you worked in the teaching sector, you were applied or you were defaulted into a certain fund. Now, these were historically called non-profit. Now the name has evolved to being profit to members. And that means that essentially the objective of these funds is to keep costs as low as possible, not to seek profits because they're not able to pay dividends to, and they're not owned by shareholders, they're owned by members. While the objective is to keep costs low, the average fees from industry super funds are actually quite similar to other options across the industry these days. There are a couple of reasons for this, but ultimately what the most interesting part of this is that industry super funds have become massive investment institutions. So from the early days of member or union or member-directed boards, there are a number of funds now over $100 or $200 billion in assets under management. Their long-term performance has been strong, and a big part of this has been their early adoption of alternative asset classes like venture capital, private equity, unlisted infrastructure, unlisted property, and those direct assets that can be difficult for investors to access directly, particularly without a financial advisor. But I think a key here is that the entire industry super fund sector does not perform the same. Some funds have different tilts in different directions, and the difference in performance can be highly material and very significant. The 3 key benefits of an industry super fund are that outsourced professional management. 2 would be the somewhat attractive costs compared to alternatives, but ultimately you have to compare individual product to individual product. And also insurance. So industry super funds are incredibly well suited to those in their early stages of their career and accumulating capital and saving a lot, given what can tend to be a more aggressive investment approach. But they also have the benefit of group insurance. So it can be much easier and much more cost effective to get insurance via an industry super fund. A couple of the biggest drawbacks are the limited investment options that industry super funds offer. So in most cases, you'll be limited to, say, 4 or 5 risk profile or asset allocation and fully invested options, as well as 8 or 10 asset class specific or investment specific options. While many do offer a member direct option, it's not a big part of their offering. One of the other parts is that it's very difficult to get comprehensive financial advice from an industry super fund or to work with an industry super fund to get that advice. Another one, along with the limited investment options, is that there is limited transparency. Given the size of these institutions, they have the ability to move the market, and it can be very difficult to know exactly what's influencing your returns on any given day. I've found that working with hundreds of clients, that one of the most important things and most valued things when they get to retirement is being able to understand what's driving their cash flow, what's driving the movement in their unit price every day. And that's very difficult to do via one of these large accumulator and growth focused funds. You can imagine with such huge amounts of default contributions in the billions coming in every quarter, A big focus of these funds is to be able to deploy that capital on a regular basis rather than having it sitting in cash. Now, at the other end of the spectrum, from that fully outsourced option, is a self-managed super fund. In this case, you get to manage everything yourself. You're responsible for every decision. They're originally opened or allowed to help small business owners own their premises, completely legitimate, and now they're one of the fastest growing parts of the superannuation sector. There are a number of reasons for this. And again, while we talk about costs for industry funds, the costs for running an SMSF for those with larger balances, and ASIC has come out in the last year or so suggesting that anyone with a balance less than $500,000 should not be considering or should be very carefully considering the decision, and in my view should seek advice, given the cost can be high for lower balances. But the cost of SMSFs is ultimately fixed. All you have to do as an SMSF trustee is have a tax return completed and have your super fund audited every year. You can control every other decision, every other cost. That is the base cost. And being a fixed cost rather than a percentage cost gives SMSFs a scale advantage and a size advantage, particularly when balances increase from $1 to $2 to $3 million. The other key benefits are the opposite of industry super funds. They offer full transparency. You can control every investment you put in there. You can make every decision over your retirement capital. Now, we always suggest you seek some advice in doing that, but you're able to see every investment. You're able to know where every dollar is coming from, and you're able to plan cash flow down to the cent if you want to. A couple of the biggest drawbacks of an SMSF are that, yes, given the fixed cost, it can be higher for lower balances. And two, there's a lot of fear-mongering around this too. There are responsibilities as a trustee. But ultimately, as long as you're managing your SMSF with the support of accountants and advisors where appropriate, you're able to manage those responsibilities. And the biggest part of those is to ensure that the sole purpose of your superannuation fund is to provide a retirement income. That means no dealing with yourself, no transacting with yourself, and basically running this as a professional individual entity. One of the other drawbacks of this is the additional paperwork, but ultimately the appropriateness of each super fund really comes down to the objectives and needs of each individual person, but there are plenty of options for each person to consider and plenty of options within those options to further complicate it. Now, moving from SMSFs into the corporate superannuation industry, corporate superannuations are generally things we inherit from our job, and in a lot of cases, they are subsidised by our employer. You think some of the largest investment institutions in Australia. These can be incredibly beneficial and cost-effective while your employer is paying for them, but in a lot of cases, once you retire or stop working for that group, you lose that subsidy, and these end up being quite significantly more expensive in cost than you thought before. Again, some of the benefits are fully outsourced solution with professional management, sometimes access to more unique investments, performance across the industry, not just for one or the others being quite strong. And probably again with corporate super plans is the significant benefit of insurance tied to your employment. The drawbacks is that without those subsidised fees, the cost of these options becomes significantly more expensive. In a lot of cases, they are aligned to an investment manager or a corporate and have their own internal products or solutions. And historically, this is, and in a lot of cases, this can be high cost. Now, the final option I want to talk about is what's known as a platform. Now, most of these are used in partnership with advisors, and they can be used for both investments and for superannuation accounts. I'd suggest it is like a light version of a self-managed super fund. Examples in this part of the market include things like NetWealth, like Hub24, like Colonial First State, and on and on. Ultimately, these are super funds that seek to get the benefit of an industry fund in having an external custodian and trustee of your superannuation assets, as well as the benefit of an SMSF, where you have the ability to have full transparency and control over your investments with the support of an advisor, but in a closed and safer framework. So the key benefit is that transparency and control. They also open the opportunity to benefit from financial advice, both investment and strategy, which we know can add significant value. They have a greater range of investment options, and ultimately, in this case, there is no paperwork in a similar way to an industry fund. A couple of the other less widely understood benefits are the fact that platforms can offer access to investments and funds that you wouldn't be able to access elsewhere. They are also able to negotiate discounts to some investment strategies, and they also can allow you to invest in assets that you can't buy through the other alternatives. So overseas shares, overseas funds, overseas property, all kinds of alternatives. The biggest drawback, naturally, and this has had some similarity throughout, is that these platforms charge a cost to take care of all that administration and trustee work for you. Similarly, while the investment menu is significantly broader than the industry fund options, it is slightly more limited than the self-managed super fund option. In some cases, they can be quite rigid, and the other drawback for those seeking to manage their money solely by themselves is that in most cases, you need a financial advisor to support you in executing investment changes via these investment platforms. So just going back through that, We've got industry super funds, self-managed super funds, corporate super plans, and platforms. And now when it comes to accessing your super, ultimately you have two main options. For most people, it's going to be beneficial and the best tax outcome by commencing your pension when they hit retirement. But again, you need to seek financial advice before executing that. And for others, there are opportunities to draw lump sums, whether you need to pay off a mortgage or if you don't want to access all your superannuation yet. And this can also depend on your age. As always, I hope you find this useful. Please subscribe to the page, please comment, and please let us know if you've got any questions or areas you'd like us to cover in future videos.